Trump gave Iran a 24-hour deadline that expires tomorrow. Yet the market's recovering today despite all of the background drama. Why is this happening? Well, this rebound so far is entirely mechanical, and I'll explain exactly why that is. So in the last video, we discussed how throughout the end of February all the way through the month of March, market makers were trapped in a short gamma, short volatility position that culminated with a dramatic end around the JP Morgan collar put strike at 64.75. Now, on the video, despite all of the background risk with respect to the war, I was careful to articulate that the base case should be to expect a mechanical rebound. Why? The main reason was because all of the negative gamma that the market was dealing with expired on 3/31. On March 31st, during this expiration, another thing happened too. When JP Morgan rolled their collar on March 31st, they sold back a tremendous amount of Vega to the market maker and dealer community. Now, importantly, when this happened, it helped kick off a mechanical rally that happens when vol drops and market makers have positions that are long Vanna, as I talked about in that same video. This was a situation in which no matter what the background news, the trade itself, combined with the existing market structure, provided the catalyst for the rally to begin. And now here we are, 200 points higher, with the rally continuing to persist despite the headlines. So obviously we know the risk is not resolved. The war is still ongoing and Trump has a deadline with Iran. So how do you play this? The tension between the mechanical rebound or the base case and the very real risk. Now, obviously this is not financial advice, but to play a situation like this, what you want to take advantage of is directional movement, but movement that slows. Because as you can see in VS3D, every single day we move like this and these hedges disappear off the profile, we are leaving behind negative gamma environment, but we're also meeting positive gamma to the upside, which helps to slow the market. So don't expect a slingshot to new highs, rather a slow grind and a recapture of levels like 6,700, 6,800, and maybe testing 6,900 over the next month. So for me, when I want the directional exposure, but I still think that options are pretty expensive, I'm going to use a structure like a call fly. What I spelled out last week in VS Pro, the end of April, 6,600, 67.5, 6,900 call fly, long the wings, short the 67.5 calls. With the call fly centered as it is, if we do get a slow drift up that stalls around 67.5 or 6,800, with a $30 entry, you stand to make over $100 net if the trade works in your favor. Now, the call fly is set up to maximize your P&L. Every day we advance the calendar and we're in the middle of your strikes. That's how you turn a structure that costs $30 into a payout of up to $150. But if the market does sell off on bad news, if Trump announces something and the world doesn't like it and we have a hard sell, what happens then? Well, because of the way the call fly is structured, even a hard sell of maybe $100 or $150 does not wipe out your P&L. Now, a trade like this, because of the way it's constructed, especially with 30 days to expiration, a hard sell-off does not take you out of the trade. Even on a day like Thursday, April 2nd, where the S&P dropped around $100, this trade only dropped $1.50, leaving your premium virtually untouched. Now, the trade I just described is exactly how I'm playing the mechanical rebound. But if you're looking for a hedge, something more long-term, my partner Matt, co-founder of VS3D and partner in Vol Signals, has spent nearly 30 years managing longer dated volatility trades. And this is how he sees the setup going forward.
As Dan just discussed, there's been a lot of volatility over the last month. And what we've seen since March 31st is a big decrease in vol. We saw the VIX go from over 30 to around 24. If you are still concerned about the macro events out there, my opinion is that the implied vols are not going to come in much more before there is some resolution. So if you're concerned about the war and want a longer term hedge, one thing that I like is the SPX June 4700 puts. These puts have had a wild ride over the last month. Prices have ranged on these things anything from like $17 all the way up to $45 in some vol spikes. Currently, they're at their lowest price they've ever been. This is due to both time moving forward and the fact that volatility and skew have come in. So in my opinion, they represent a good risk reward if you're concerned about the longer term macro picture. I'm not saying I think the market's going to go to 4,700. That's not at all what I think. But what I'm saying is that if we do get some negative headlines and the market sells off a few percent, these puts could easily go from $14 to $30. So you could double your money if we get a risk off event.
It's critical that you understand how to read the data and how to navigate it in real time. If you want to be up to date day to day as conditions change, check out VS Pro. If you just want the data, try VS3D for yourself with a 7-day trial.